Since the Fed cut the Fed rate, does that mean that mortgage rates are also coming down?
Then we could essentially double the number of active buyers.
By the time the rate cut happens, it's already baked into mortgage rates.
Even in a market like ours, where half of the buyers are purchasing with cash, the mortgage rates still matter. Welcome back to Coffee Chats. I'm Tara.
And I'm Kate. There's been a lot of rate talk recently since the Fed rate cut in September. And the question that we've been getting the most is, since the Fed cut the Fed rate, does that mean that mortgage rates are also coming down?
And what will that do to the market? Both great questions and not exactly a straightforward answer, because the Fed doesn't directly set mortgage rates. What the Fed sets is that federal fund rate, and that's the short-term rate that banks charge each other. It influences the economy, but mortgage rates are actually based on inflation, the bond market, and what investors expect the Fed will do next.
Exactly, which is why actually oftentimes the mortgage rates come down before the Fed rate changes. It's in anticipation of the announcement, and by the time the rate cut happens, it's already baked into mortgage rates.
And changes in mortgage rates can affect the market because it influences buyer demand. 0.25% drop like we saw in September is not really enough to make a big impact in a vacation home market, but being in a downward trending rate environment certainly can.
Right. And in a downward trending rate environment, we typically see more showings, more offers. Sometimes houses will sell a little more quickly. In an upward trending rate environment, buyers tend to be a little bit more hesitant, and houses may sit on the market a little bit longer.
Yep. Now, even in a market like ours, where half of the buyers are purchasing with cash, the mortgage rates still matter. If rates drop enough to bring financed buyers off the sidelines and into the market, then we could essentially double the number of active buyers. And as we always say, everything comes back to supply and demand.
Plus, many cash buyers are also investors. When CDs and bond rates are high, they tend to want to keep money in those investments. When yields fall, real estate starts looking like the better choice.
So what happens next? Well, Fannie Mae is projecting rates to be around 6.4%, this is the 30-year mortgage rate, by the end of this year, and then dropping to about 5.9% by the end of next year. So this is a very gradual decline and not dramatic.
But we don't expect that gradual decline to be a smooth one either. Sticky inflation or bond market volatility could push mortgage rates higher again, even if the Fed keeps cutting those short-term rates.
Yes. Think of it this way. If inflation continues to cool and the economy eases, then there's room for rates to ease. But if inflation is higher than expected or markets get jittery, we could see temporary spikes. So expect a bumpy road.
And the takeaway for sellers is this. Mortgage rates affect the market via buyer demand, so it's certainly something to keep an eye on, and it could impact the timing of your sale. But like everything these days, rates are going to be volatile, and they're only one piece of the puzzle.
So if you're thinking about selling, now's the time to talk strategy. We can help you understand how these rates affect your specific property and how to position your property in today's market.
As always, we want everyone to be comfortable and confident in their decisions, so if you know someone who's selling, please share this with them.